I'm here again with Group CIO Dan Ivascyn for an inside look into some of the recent discussions taking place in the Investment Committee, or IC. Thanks for joining me today, Dan.
Thanks, David.
So one of the themes we've heard a lot about lately is de-risking, and several PIMCO portfolios have been taking a more defensive posture. So how is the IC thinking about the theme of de-risking, and what are some of the implications for client portfolios?
Let me start by talking a bit about our fundamental outlook. We've spent a lot of time, even in recent days and weeks, looking at our assessment for policy for economic growth around the world, with a focus on the risks to a sustained period of negative growth or recession. And we as an organization still think the probabilities of a recession over the near term are relatively low. So we think we'll be in an environment where volatility may increase a bit. We don't see a global financial crisis ahead of us. So I don't want to sound overly alarmist, but looking at asset level returns, we've seen continued tightening in credit spreads, mortgage spreads, declines in volatility, whether measured by the VIX or a measure of an equity volatility, even volatility in other markets like fixed income assets. So our view has been to use this opportunity to gradually take our accounts that had been overweight this type of risk down towards more neutral levels. We don't necessarily think it's time to get very negative these risks. We still like credit. We just think at these valuations, investors want to be a bit more defensive, a bit more cautious, and build flexibility for the future. And we believe that in this environment, an investor should look to take advantage of many sources of alpha in return that are less correlated or even uncorrelated with one another, and sources of return that take advantage of structural inefficiencies in markets.